Okay, great. So, yes, there aren't any lectures next week. Um, yeah, there aren't any lectures next week. You guys are studying next week. We're going to have consultations instead. Okay, cool. So, we're going to look at additional example 2 today. And basically, so you guys need to zoom in on your side. I'll zoom in on my side. We in the last few lectures, we did a lot of theory. We didn't do too much practical. So this is what this lecture is all about. It's all about the practical. I'm going to focus a lot on transaction 1 because transaction 1 is the one that's hedge accounting. Transaction 2 is a loan, and sort of we've done a loan before in class, and so I'm going to go quickly through transaction 2, but the main one that I want to focus on is transaction 1 because that's the one with the FEC, right? And that's the new thing that we're dealing with. Right. Okay. Cool. So let's have a read of the required. Right. So the required says record all relevant journal entries for only. Now, this is typical of a Forex question, right? So in a Forex question, you're going to get multiple transactions. Your job is to identify which required is asking which required relates to which transaction. It's critically important that you do this exercise because sometimes what you're going to find is that one transaction might have multiple requireds and then another transaction will just have one. So you need to make sure that you're answering based on the correct transaction. So that's why you'll find that I will always, in all of your questions, I'll always put that in bold. Right, so you can see there it says transaction 1 in bold. Right, so, and I'll also always have an only in front so that you know not to look at the other transactions. Okay. Okay, so it says for only transaction 1 in the General Journal of Google Limited for the period 1 September 2013 to 30 September 2014 in accordance with IFRS. Okay. And then obviously, so that's required A. Now let's just deal with transaction 1. We'll come back to required B and transaction 2. Okay. Cool. Okay, so the note. Let's just read the note because it's important that we go through this note. Right. So the note says we need to have both cash and credit transactions included in the general journal. We don't need to do any narrations, and the dates are important. Now, this is particularly important with Forex transactions or Forex questions because there's all these transaction dates, and we've got year end, then we've got settlement dates. So because of those different dates, we want to ensure that you as the student understand which date this specific thing is happening, right? So it says show all calculations and cross-referencing round to the nearest rand. Normally you'll see what I would say is round the final answer to the nearest rand, because I don't want you rounding in between the calculation, because that's going to throw your calculation off from what's in the memo. So you need to get into the habit of rounding off the final answer to the nearest rand, and then we don't worry about tax, right? So then moving on to the information. So if you guys scroll down, moving on to the information, it says Google Limited imports and sells baby chairs. The financial year end for Google Limited is 31 August. Okay, so that's our year end. But let's go back to the required, scroll up to the required. It says we need to prepare this for 1st September 2013 to 30th September 2014. So we starting on the first, so basically, firstly, that's 13 months, right? So it's not 12 months, it's 13 months. So we're starting on the first day of the year, right? First day of the financial year. And we're completing that 12-month period, that entire 12-month period. And then we're going to have to revalue our monetary items at year end. And then we only settle, we don't know the settlement date yet. We only need to stop journalizing on the 30th of September after year end, right? So let's see let's see if we can identify what's happening. So it says Google Limited imported baby chairs. So I'm back at under transaction 1. I'm reading under transaction 1, the first paragraph. Google Limited imported baby chairs for 10,000 yen. Now, yen is the Chinese currency. All right, so for 10,000 yen from Bambino Limited, a supplier in China. This inventory was ordered from Bambino Limited on 1 September 2013, right? And was shipped free on board from the port in China on 3 October 2013. Okay, the inventory was delivered at the factory of Google Limited on 7th October 2013. Right, so you guys are going to get ready in the chat for me. Which, and the question that you're going to answer is which date, right, is the transaction date? Is it the 1st of September? Is it the 3 October or 3rd of October, right? Or is it the 7th of October? Which is the transaction date? Okay, so we've got one person in. The other people are unsure, I think. Which is the transaction date? Which is the transaction date? There we go. So there's two people now. So the transaction date is the date on which the goods were shipped. So now I'm going to underline that word for you, right? We're looking for that word, shipped. Okay, so when you go to your questions, guys, please look for the date on which it was shipped. Okay, so just a recap, right? When we're dealing with a creditor, when we're dealing with purchasing inventory, or maybe we purchasing some sort of plant or equipment or something like that, we're not worried about the date that the order was placed. We're not worried about the date that it arrived at the company. We're not worried about the date it was installed, at least not for Forex. We're not worried about these dates. The dates we're worried about is the date it was shipped, because that is the transaction date. Okay, so just keep that in mind when you're doing your exams and your tests and preparing for them. The date that we're worried about is the date it was shipped. Okay, not the delivery date, not the order date, not these other dates, right? So what you're going to see is when we scroll down, if you just want to take a side detour, if you scroll down to the exchange rate dates, I've given you all the dates there because I'm giving you enough rope basically to hang yourself. I'm giving you enough rope to make a mistake, right? But you need to be smart enough to know that it's not about all of the dates. We're looking for the transaction date only. Okay, so that's 3rd of October. The people that have answered in the chat are correct, right? 3rd of October. Okay, let's continue reading now. Back at the top, I'm reading the statement that says the amount. So it says the amount owed to Bambino Limited is payable as follows. So on the 28th of February, so the last date of February 2014, we're going to pay 40%. And then 30th of September, so this now is the date that we need to stop recording, right? So that's the last journal. The last journal entry you're going to pass is for this date here, the 30th of September 2014. So on that date, we're going to pay 60%, right? So they are basically asking us, if you have a look at the dates, they're asking us to go from before the transaction date, right? So the 1st of September, which is before transaction date, all the way to the last settlement, right? So they're asking us to prepare those journal entries for all of those dates, right? So let's have a look what it says next. So I'm reading where it says on 1 January 2014, the company decided to hedge only the second payment, right? So which payment? Only the second payment. So question, are they taking out the amount of 10,000 yen? Your answer in the chat now, yes or no. Is the FEC for the amount of 10,000 yen? Right. No, the amount is only for the second payment. The second payment is 60% of 10,000 yen, right? Which is going to be 6,000 yen, right? But we're going to talk about that just now. So it's 60%. So it's only the second payment, right? So question, can we have one FEC that covers both payments? The answer is no. So this is a tangent, right? I'm talking about some other scenario. Can we have one FEC that we use to pay two different payments on two different dates? No, the bank does not offer that type of forex, right? The bank wants to know what date you want the forex on. It wants certainty. So it wants to know what date you want the forex on and what amount. So you can't, for example, enter into one FEC and it covers both payments. The reason being because both of those payments are happening so far apart, right? You have to have a separate FEC then for each payment. In this case, they've only taken out an FEC for one payment. How do we know? Okay, we probably need to read a little bit more. But anyway, let's read and see if there's any coverage for the first payment, right? So it says it's to be settled on the 30th of September, right? So just the second payment against possible exchange rate losses or fluctuations, right? And it's taken out for 9 months. Now, 9 months means they're taking it out on the 1st of Jan, and it expires then on the 30th of September. That is 9 months, right? So that's all they're saying. They're saying they're taking it out for that full period of 9 months, right? And then the next statement, the one that I've highlighted there, says there's no coverage to be taken out for the first payment, which is on the 28th of February. So basically, we're going to treat this transaction as a normal forex transaction until that date that we need to start taking out the FEC, right? Because there's nothing covering the first payment. So the first payment is just going to be like a normal forex situation, and only the second payment is yes, like an unhedged transaction. Yes, so the first payment is basically an unhedged transaction, and then the second payment is going to be a hedged transaction. So what the examiner is doing here is they're trying to see, can the student switch between those two modes? Can they look at it from the perspective of unhedged and also from the perspective of hedged? Okay. Now I just want to quickly pop over. So I've changed the page. You're going to have to zoom in a little bit more. I want to look only at the additional information. So I'm not going to look at transaction 2 just yet. We'll come back to it. It tells us that Google Limited is using the Rand as their functional currency, which is fine. They use control accounts, right? And then it says they're applying hedge accounting. It says that the hedging criteria has been met. Now, these sort of statements from 3 to sort of 6 is something you're going to see on every question, right? So just be aware that these 4 statements will be in some format on your paper, right? On your question paper. And then it says, it tells you which is the hedging instrument. So the hedging instrument is the FEC, the hedged item is the creditor, and then finally it tells us that we're using fair value hedging. Right. So now we're going to start to try and journalize, right? I want to start and pass journals for this specific transaction. Okay, so the first step, guys, the first step is always and will always be us preparing a timeline. Okay? So us preparing a timeline. So this is our timeline that we've prepared. All we've done is we've taken the question and put it in a timeline format. Why do we need a timeline? Because number one, there's so many dates floating around, we need to orientate ourselves, right? So that we know which dates we need to journalize, which dates we don't. And also, it helps us to understand what are the movements that we need to look at. Okay, so it's a very good idea to do a timeline. Okay, anyway, so there's nothing that we need to do when there's an order placed, right? So we're not going to do anything on the 1st of October. Okay, are we needing to do something on the transaction date? Yes. What happens on transaction date, guys? We measure the monetary item, that being the creditor, but we also measure on transaction date is the only time that we measure the non-monetary item. Okay, we measure the monetary item and the non-monetary item on transaction date. We're never going to measure that non-monetary item again. The non-monetary item in this situation is inventory. We measure it only once, and that's transaction date. we don't remeasure, or when I say remeasure, I mean revalue it to spot rate again, right? It stays at that rate and then it goes off and does its own thing. So it'll go into cost of sales. If it's a machine, it'll be depreciated, and it stays at that amount. We don't revisit it in terms of Forex. We might revisit it in PPE, we might revisit it in inventories, but we don't revisit it in terms of Forex transactions. Okay? The only thing we're going to revisit is the monetary item. Right. So that's the first thing. Now, in the chat, you guys are going to get ready. Do we pass any journals when we create an FEC? On the day that we take out the FEC, do we pass any journals? Yes or no? In the chat for me. What do we do when do we pass any journals? Right. So people are saying no. Let's just talk about why. So again, why don't we pass any journals on the first date, the date that we took out the FEC? Right. So now remember, I'm not talking about the creditor. We spoke about the creditor when we were talking about 3rd of October. Let's just park that idea about the creditor and let's switch gears and talk a little bit about the FEC. We're not going to pass any journal entries for the FEC on the date that we took the FEC out, because the cost of the FEC is equal to, right, the fair value of the FEC. Like I told you guys before, if I went to the bank in the morning and took out an FEC and I said I want 6,000 yen and I want that yen to be due in September, right? And I took it out in the morning, they would have given me a rate. They would have quoted me an amount. And then if I went there an hour later and I said, listen, I want to find out if I take out a contract for 6,000 yen and I want it due on the 30th of September, how much would it cost me? They're going to look at me and say, why are you being so dumb? We just gave you a rate. The rate hasn't changed in the last hour, right? We just quoted you a price. It's like you going and get a quotation from a company and then you go back 2 hours later and say, yeah, I want a quotation. I want to see if it's changed. Right. So there's not going to be any change in the value of the FEC on that date because there's nothing that's happened. Right. So we're not going to pass. So you guys are correct in the chat box. People have said no. They are correct. We're not passing any journal entries for the FEC. We're still going to pass the journal entries for the creditor. In your mind, I want you to split them. I want you to think of them as separate. Okay. Anyway, so let's look at the rates. Right. Now, again, get ready because I'm going to ask you a question. So we're not worried about when the goods were ordered. We're not worried about when the goods were delivered. Right. We are worried about transaction date. Okay. So on transaction date, we're going to measure the monetary and non-monetary item. Right. Okay. Let's just, before we get to the journal entry, I want to just park this example and I want to ask a question. In what situation would these other dates be important? Is there any situation where the other dates will be important? And the answer is yes, right? If we are dealing with inventory, PPE, if we're dealing with PPE, right? And the transaction has happened on a specific date. But remember when we did a PPE, we said it must be in the state, it must be in the manner in which management has intended, right? Before we can start depreciating it. You guys remember that? That was, when did we do that? I think like 10 years ago, right? We looked at PPE. I mean, yeah, PPE. So if we get a question and we're dealing with PPE, the examiner might throw in there that, listen, this is PPE and it was only in a state that can be used by management on a different date to the transaction date. That's possible. So we just need to watch out for that in our tests and our exams and our tutorials, right? But other than that, we're not worried about order date. In this case, when we're dealing with inventory, we're not worried about order date and we're not worried about the date it arrived at the company. But I just wanted to tell you that there is, and if you do your tutorial questions, you'll see it there. There is one or two cases where the examiner tries to integrate inventories, PPE into this section. Right? So just be aware of that. Is PPE part of the back to 100 scope? I'm assuming you're talking about the exam. Yes. So if you go and have a look at your scope that we released, you'll see that we say there's certain topics that you need to have prior knowledge about, and we talk about inventory. I can't remember if there's PPE there, but it might be. But yeah, so I just wanted to make you aware that that is a case. So go and have a look. PPE is part of Forex. Yes, we can test PPE as part of Forex. Yes, we can. Yeah, they can. Yeah, they can. You'll see it in your tutorials. Okay, right. So that was just, I went off on a tangent, and I hope I didn't lose too many people. But let's come back to the example. let's return back to today, right? And so, right. So let's pass the journal entry to recognize the monetary and non-monetary items. So transaction date journal entry, and let's see if we can get right up to 1st Jan. So on the first journal entries that we're going to pass, we're taking ourselves from there to there, right? Remember, we only remeasure monetary items on either settlement date or year-end date. None of these dates, where the red line is settlement or year-end. It's only transaction date to the FEC date. So let's have a look at what the journal entries look like. So we're debiting inventory, obviously, because inventory is increasing. We're buying new inventory, right? So we're debiting inventory. Remember, inventory is an asset, increases on the debit side, right? So we're debiting inventory, and then we're going to credit the creditor, right? And when we credit the creditor, we're saying that the creditor is getting bigger. Notice the rate we use is, so I'm going to go back to the rates now. It's number one, the spot rate. So it's not the forward rate. It's the spot rate, and it's at transaction date, right? So the spot rate on transaction date is what we're using. And so we say 10,000 yen times by 2 Rand 48, and that's going to give us 24,800. Okay, cool. Most of us are comfortable with that journal entry. Most of us are going to get it right. Okay. Now, notice what I've said here. I said there's no journal entry on the date that the FEC was taken out, right? No journal entry. But if the student has included a journal entry, we're going to minus half a mark because the student has indicated that they don't understand FECs. There's a lack of knowledge, right? Can you see that? That is what you're going to start to find in your tests and exams. There's a penalty if you don't understand this topic of FECs, right? So it's clear that if someone passes a journal entry on that day, they haven't been to the lecture, right? And they don't understand why the FEC, the fair value of the FEC, is equal to the cost, so it's zero, right? So they don't understand why that is the case. Okay. So you're going to start to see that there's this penalty here that comes through. Okay, now let's go back. So far we have started off on transaction date. We've traveled all the way to the 1st of Jan. Now I want to take you guys to the first settlement date. Now we're going to take you to the first settlement date, which is the 28th of February. Okay, 28. Can you see how valuable the timeline is, right? It puts everything in perspective and lets you know what to do next, right? So please just focus on getting the timeline right. But before we pass the journal entry for that, I have a question that I want to ask you guys. Right? Oops. What just happened? Let's go back. Right. There we go. So I'm going to open the poll. Just give me a few seconds now, and then you guys can start reading the question. Just give me a second. Okay, so the poll is up. It says, what amount are we going to revalue, right, on the 28th of February 2014? So what amount will we revalue on settlement date is what is being asked. And what amount are we going to revalue on settlement date? Okay, there's 4 people that we are waiting for. What amount are we going to revalue on settlement date? What amount? Okay. I'm going to, in the interest of time, I'm going to just show you the results. So the majority of people here have said, listen, we're going to revalue the 4,000, right? 4,000 yen, 100% correct, right? Why? Because we only need to revalue the amount that is being settled. So how much is being settled in 28th of February? 40% of the total, right? 40% of the total is 4,000 yen. Does everyone understand that we're not going to revalue the full 10,000 because it's not being settled? We can't revalue the 6,000 because it's not being settled. We can 6,000, yeah. We can only revalue the 4,000 because that is the amount that's being settled. That is the rule, right? We only revalue the amount on settlement date. We only revalue the amount that's being settled. Obviously, if the full amount is being settled, we're going to revalue the full amount, right? But now only 40%, only 4,000 is being settled. Right. Any questions about that? I need you to let me know. Okay. Right. So let's have a look at. Remember this first what you call it? This first payment we're going to treat as an unhedged, right? Unhedged item. The first payment is an unhedged item, right? So we are now going to move that 4,000, right? The 4,000 yen, we're going to move it from there down to the settlement date. We want to revalue it at the settlement date. Now in the chat, get ready. In the chat, is it going to be a gain or a loss? So you need to ask yourself, is this a debtor or a creditor? That's the first question. Then is the debtor or creditor, whichever one you decide it is it getting bigger or smaller? Right? And that's going to start to tell you whether it's a gain or a loss. Right? So in the chat, pop in the chat whether it's a gain, whether you think it's going to be a Forex gain or Forex loss. Okay, so someone says loss. There we go. Right. So it's going to be a loss. So for those students that don't understand, let's just revisit why it's a loss. The amount is 2 Rand 48 at the beginning, right? It ends up becoming 2 Rand 83, so it gets bigger, right? And it is a creditor. When creditors get bigger, we make a loss, right? So that's the first thing. Do we need to, second question, do we need to pass any journal entries for the FEC? Answer, no, because the first payment is not covered by this FEC. You see, the first payment is no relation to the FEC. So we're not passing any journal entries for the FEC. It's just going to be the 4,000 yen. So what journal entries are we going to pass? Firstly, we're going to revalue it, and guys have correctly said in the chat there, we're going to make it a loss, right? So we're revaluing it, it's going to be a loss. The next journal entry, and I say this over and over again, is a journal entry everyone forgets. We need to actually record the payment. Okay, so we're going to look at 2 journal entries now. The first one, there we go, is a loss, correct? There we go, we were right. And when it's why is it a loss? Because the creditor is getting bigger, right? We're moving from 4.8, we're moving to, 2.48. We're moving from 2.48 to 2.83, right? So we're getting bigger, right? Notice how they're only revaluing the 4,000, only the amount that is being settled. And then this journal entry is the one, guys, please, please, please don't forget this journal entry. Everyone forgets this one. We need to pass the journal entry to record the actual payment, right? So this is the actual, now the payment is actually happening, right? And so the mechanics behind this, we debit the creditor because the creditor is getting smaller, we're paying them. We also credit bank because bank is getting smaller, right? Money is leaving. And we use the spot rate on settlement date. It's the rate that we revalued that 4,000. See, in this journal entry above, we revalued the 4,000. Now, in the journal entry below, we're eliminating it. We're taking it out. We're paying it. Okay. If anyone has any questions, please just pop it in the chat. Right. So, guys, we are actually now at first settlement date. Right. So that's where we are. We're wanting now to go to year-end date. Okay. Now, question: with the creditor, right? So we paid the 4,000. So we've got 6,000 in the outstanding still, right? We paid the creditor 4,000. There's 6,000 outstanding. What rates? How are we going to remeasure that 6,000? Remember, we never remeasured it on the 18th, on the 28th of February, right? We never remeasured that 6,000. So the 6,000, we're going to be taking it from transaction date to year end. Everybody understand? We're taking that 6,000 from transaction date to year end, right? So that's the rates that we're going to use, right? For the FEC, we created the FEC on the 1st of Jan. So the FEC is going to go from the 1st of Jan to year end. But remember, for the FEC, we're not going to use the spot rate. We have to use the forward rate, right? Remember, we used the forward rate throughout to measure the FEC, but then right on the last day, we're going to change it, and I'll tell you why. We're going to get to that just now, right? So don't panic, right? So now with the creditor, we're moving from 4.8 all the way down to year end of 2.77, right? So we're moving from 4.8 to 2.77, right? With the FEC, we're moving from the 1st of Jan, which is the date that we created it, or we took it out, to year end date, which we're moving from 280 to 2.84. Right. So the first question, now let's deal with the creditor. Is it going to be a loss or a gain on the creditor? Loss or gain? In the chat, is it going to be a loss or gain with the creditor? We're moving from 2.48 to 2.77. Loss or gain? Can you guys hear me? Oh, there we go. Loss. Right. There's going to be a loss. Now, so let's park that one side. With the FEC, what's happening with the FEC? When we bought the FEC, meaning when we got into the contract, we got into the contract at 280, right? Got into the contract at 280. But now that same contract is worth 284. So is it a loss or gain on the FEC? Loss or gain on the FEC? We bought, right? Or you can call it a profit, yeah? We bought in at 280, right? We locked in at 280, but the fair value is now 284. So on the FEC, we are making a gain. You see, and you'll often find this in your questions. They move in the opposite way. That is the hedging relationship. Remember, we said on Tuesday, hedging is to try and net off. We're trying to net off the loss or the gain from the creditor. So that's why they move generally. They move in the opposite direction. Not always. Generally, they move in the opposite direction. Right, so let's have a look at what that journal entry looks like. There we go. So it's a loss on the creditor. Oops, wait, wrong color. So it's a loss on the creditor, right? The creditor gets bigger. We move from 2.48 to 2.77, right? And we're only moving the 6,000. Remember, the 4,000 was paid, right? We took out the FEC for 6,000 only, right? And now we're moving from 2.8 to 2.84, which means that's a gain. So that's why we're seeing gain there. And we're debiting the FEC. Notice again how we said FEC, asset or liability. We always want to use all asset or liability so that we don't need to keep a track of when it's an asset and when it's a liability. If we don't, we're going to get marked down because and if we don't keep a track of it, right? So if you do it and you constantly keep a track of it, then that's fine, you'll get full marks. But if you don't track it and you get it wrong and you call it a liability when it's actually an asset, then that's going to be a problem, right? But so basically, to cut a long story short, let's just use FEC asset / liability, right, in our test exam. Anyway, so the 6,000 times the difference in the creditor and the spot rates is going to give us 1740, and then the 6,000 times the difference in the forward rates, right? These are the forward rates, is going to give us 240. Okay, cool. Right. So now we find ourselves at year end. Where do we go next? What do we want to do next? We want to move from year end to settlement date, right? And we also want to take our FEC from year end to settlement date. And then what else do we want to do? Remember the journal entry that we always forget? We want to record the payment. Okay, so there's 3 journal entries that we're going to pass. We're going to revalue the creditor, we're going to revalue the FEC, and then we're going to actually pay the creditor and eliminate the FEC. So there's 3 journal entries we're looking for. So let's have a look. Where are we now? We have gotten lost. There we go. Okay, so if we have a look at the rate, I'm not going to go, I mean, you guys have got this down already. This is the smart group. So we're going from 2.77 to 2.74. So that's obviously a gain, right? Now, with the FEC is expiring on the 30th of September, right? So what happens on the 30th of September? We're going to give the bank the 2.80 for each yen, right? And then they're going to give us 6,000 yen. So we're going to give them 2.80 times 6,000, right? Whatever that amount is. We're going to give them that. Then they're going to give us the 6,000 yen. Then the question is, what is the fair value of that yen at expiry date, or on the date that the FEC comes to an end? What is the fair value? Right. And the answer is the fair value of this FEC will be equal to the spot rate, because that is the fair value of the currency on that date. Does everybody get me? Have I lost anyone? Is anyone confused? Right. If you are, please start typing, and then I can find you wherever you are. So again, let me explain it again. On that date, we went to the bank and we gave them our rands, and they gave us yen. Right. So then the question is, on the expiry date, what is the fair value? Right. And then the fair value is the amount is equal to the spot rate. So therefore, on the expiry date, we no more measure the FEC at forward rate. We start to now measure, or we only measure the FEC at spot rate on that date only. This is the only time we do it, right? And the rationale, the reasoning behind it is because the yen that we receive on that date is therefore equal, in fair value, is equal to the spot rate. Okay? Thumbs up in the chat if you understand. if you guys, yeah, okay. Okay, cool. So please, guys, if you don't understand this, please, this is like a critical thing that we have to get right. Okay, so let's have a look at what the journal entries are. So again, like we said, the creditor is decreasing, so we're debiting the creditor and we're creating a profit there. Remember, we're moving from 2.77 with the creditor to 2.74, right? And it's only for 6,000. Okay, so that's going to give us a 180 rand forex profit. Okay. Someone in the earlier group asked me, can we use the word FEC in our journal entries? Yes, yes, you can. Right? So yes, you can use the FECs in the journal entries. What I don't want to see in your journal entries is the word Forex. Right? I'll use it in class, right? But it's only for over 30s. So only if you're over 30 can use the word Forex. So Forex, I would rather you write out foreign exchange, right? Please. But the word FEC, I'm going to give you the mark if you put FEC because it's a commonly accepted word in accounting. Okay. Anyway, back to our story. So we said we're going to move from the forward rate of 2 rand 84. We're going to move to the spot rate of 2 rand 74, which means we are going down. Means the fair value is decreasing. Therefore, it is a loss. Okay, and then we debit the FEC. Right, now the last payment, the last transaction at least, is the transaction we all forget. The only reason why I say we all forget it is because I want you to remember it. Okay, so we all forget it. And here we are debiting the creditor. Notice what rate we're using, spot rate. And notice what rate the bank is at. The bank is at 6,000 times the forward rate that we had agreed on. The forward rate, let's go back to our rates. The bank is using this rate, the rate that we opened the FEC with, right? Because that's the rate we agreed with the bank that we're going to pay. So the bank is 6,000 times the original forward rate. Okay, and the difference between these two amounts is going to be the value of the FEC asset or liability. Right? So let's just double check that. We came in with a debit of 240 rand. Right? There's the debit there into the FEC asset, and then we credited him after that with 600 rand. So if we net those two amounts off, we're going to get 360. Okay. Now, very briefly, I know that we're almost out of time. Very briefly, I just want to look at example 2. Transaction 2. So transaction 2, like I said, there's no FEC here. So it's going to be very similar to something like what we would have done in the past. So basically, just to give you a synopsis, we took out a loan on the 1st of January 2014. The amount of the loan was $20,000. Right? We're going to pay in full after 2 years, right? Which is in 2015, December 2015, and the interest is at 12%. Right? Notice what they say here: interest is paid in arrears. That means we're going to create that fake creditor, right? That creditor called accrued interest, called interest payable, called interest accrued. We're having to create that creditor, and that creditor now is a monetary item, meaning that we need to remeasure him all the time. Anyway, the interest is obviously accumulated at an average rate. So it's accumulated every day, every month, every hour sometimes, so it's accumulated over a period in time. Therefore, we use the average rate. All right. So let's have a look at what that looks like. Right, we're gonna go a little bit fast through it because I know that people want to go. Just 1 minute. Okay. So these are our, so this is transaction date, 1st of Jan, which is when we took out the loan. Remember with the loan, how do I identify transaction date? It's not the date we applied for the loan. It's not the date that we submitted the documents for the loan. It's the date the loan was obtained, right? The date the loan was obtained, right? Sometimes it might say the loan was granted on, the loan was obtained on, right? Or we borrowed on. So it's not the application date, not the documents date, it's the date the loan was obtained. Okay, anyway. So we started off, we need to measure at 9 Rand 45. What do we need to measure at 9 Rand 45? Firstly, the money is coming in, right, into our bank. So we're going to debit bank. We need to measure that at 9 Rand 45 because that's the fair value of the money at that time, right? And then we need to create that creditor, that liability, right? And the liability is the monetary item. That's the item that we need to keep remeasuring. Okay. Sorry, did we talk about the required? We didn't. Okay, so the required, it says for transaction 2 only until the 31st of August. Right, so we're only moving from the 1st of Jan to the 31st of August. We're not passing any journal entries after that. Right? So that after that is not important. Okay. So let's have a look at the first journal entry. This is what I was talking about. We're debiting the bank because the money is coming in. We're creating the liability and we're doing it at spot rate. Okay. Now, is there any interest on the first day of the loan? No. So we don't need to recognize any interest. What we need to do is we now need to move to year end. So what we're going to do at year end is we're going to take that loan and we're going to move him from 945 to 1018, right? So now let's leave the loan one side. Let's talk about the interest. The interest, because it accrues in that manner that we spoke about, where it accrues over time. So day by day, month by month, hour by hour, right? It accrues over time. We must then use the average rate to record the interest expense. Okay, we use the average rate to record the interest expense. However, the creditor, the fake creditor that we have created, I call it the fake or additional creditor, but like I say, you must never call it that in your TESO exams. The accrued interest, right, that has been created because we are paying this interest in arrears only. The accrued interest, the creditor that we've created is a monetary item, and that item needs to be measured at spot rate. So we need to firstly journalize the interest, and then we need to move that interest to the spot rate. So then we need to move the creditor, the accrued interest, we need to move it to the spot rate. Okay, so let's have a look at what that looks like. So this is, firstly, we're revaluing the loan, right? So that's the first part that we're doing. So we want to revalue, we want to revalue the loan. And what are we doing? We're moving it from 9 Rand 45 to 10 Rand 18. Let's see what that journal entry looks like. So this is what it is here. We're moving from 9 Rand 45 to 10 Rand 18. Remember, we can only use this method where we put the two amounts in a bracket like this when we're using direct rates. We can't use it when we're using indirect rates. All right. So just keep that in mind. So we move it from 9 Rand 45 to 10 Rand 18. Excuse me, and we multiply it by the total value of the loan, and that gives us the fair value. Right. So now another question. With regard to the interest, we opened up the loan on the 1st of Jan, and now is the year end on the 31st of August. How many months have passed? So how many months of interest have we had? You answer in the chat. How many months of interest have we had? We opened up the loan, we took out the loan on the 1st of Jan. Now is the 31st of August, right? How many months of interest? Count on your fingers and toes. 1, 2, 3, 4. January, February, March, April, May, June, July. There we go. Okay, 8 months of interest. The rate they gave us of 12% was an annual rate. So we need to multiply that annual rate by the loan amount of $20,000, and then we need to apportion it for 8 months. Okay, right. So let's have a look at that. So we take 12,000 multiplied by the annual rate of 12%. We apportion it for 8 over 12, right? And we get total interest that we need to recognize of 1,600 US dollars, right? US dollars. And then we raise it at the average rate, because remember, the nature of interest is that it accumulates over time. So this interest expense amount, which for our purposes is going to be the non-monetary amount, right? The interest expense amount is measured at the average rate, right? But in the creation of the interest expense, we've created this additional creditor called interest accrued. Right? It's disappointing and it's confusing because in the name of that creditor, it's got the word interest. So students often get confused between interest expense and interest accrued. One is a income statement item, one is an expense, and one is a liability, right? So one is the interest expense is an expense, it's an income statement item, it's measured at average, whereas the interest accrued or the accrued interest or interest payable is a balance sheet item, right? It's a creditor, a type of creditor, a type of liability, and it needs to be measured at the spot rate at year end and just before settlement, right? Because it's a monetary item. So we raise the interest expense at the average, but this interest accrued, we need to pass another journal entry, and that's the journal entry just below, to revalue it to the spot rate. Right? So this is what we're doing here. We take it from 9 Rand 79, which is what we raised it at, and we're moving it to 10 Rand 18, which is the spot rate at year end. Okay, and as you can see, it's getting bigger, and when the creditor gets bigger, it's a loss. So therefore, we debit the loss and credit the liability, and our amount is 624 Rand. Okay, guys, thank you for staying a little bit longer. I know I went a little bit over time. Thank you for staying. If you come back tomorrow, or when you come back tomorrow, not if, you have to come back. It's the last lecture of the year. When you come back tomorrow, please can you bring with you additional example 3, class example 3, and we're going to go through that in tomorrow's lecture. Okay, thank you very much for coming and listening to the lecture, and have a good afternoon.